This week in economics on the 8th of August. On some of our outlets, this will be heard on the 9th of August. A little bit of an overview here from Old Numbers Man. Some of the topics we'll cover. Of course, we'll talk about the recent jobs report, its effect on the market, and specifically on what the Fed will do. We have a number of other things to talk about. Crude oil prices, we'll look at those. We'll look at the report if it becomes available from the U.S. Future Trading, I believe, Commission there. And we'll, at Berkshire Hathaway, it's the U.S. Commodities Future Trading Commission. That report should come out. We're doing this at about 3:30 Eastern Time, and it should come out about that time. The main story here is Berkshire Hathaway. We'll look at the markets and where they are by looking at a bellwether here. We'll go to the Wall Street Journal, and the headline in the journal is Berkshire Hathaway profits dropped by 37%. The Berkshire Hathaway Inc. second quarter profits slumped 37%. I'm just reading here, due to decline in investment gains and underwriting losses attributed to higher claim costs at Geico, and you've heard their commercials no doubt before. The Berkshire Hathaway operating profits, which exclude the impact of some inventory results, or investment results, fell 10% to $3.89 billion, or $2,367 a share, from $433 billion, I should say, or $2,634 a share 6 years ago. There, second quarter for the second quarter, Berkshire Hathaway reported a net $123 million gain from investments in derivatives, down from $2.06 billion a year ago, when it recorded a one-time gain tied to a stock swap deal with Graham Holdings, former publisher of the Washington Post. Berkshire Hathaway is a gigantic holding company which owns both operating companies and stocks. It swayed to an underwriting loss of $38 million in its core insurance business during the second quarter, Q2, compared with a $411 million gain in the quarter a year ago at Geico, the country's second largest automobile insurer. The pre-tax underwriting gain shrunk to $53 million from $393 million a year ago, mainly because it paid out higher claims more frequently, a trend that companies also referred to during Q1. Berkshire Hathaway's Geico seemed buffered by the same economics and car industry trends that hit Allstate, American International Group, you hear them, AID, during Q2, rise in the number of claims, a higher cost per claim. Industry executives and analysts cite improving economy, lower gas prices, and more complicated cars loaded with electronics, no doubt about that. Berkshire Hathaway's reinsurance agency group, another Berkshire Hathaway's large insurance operation that insures against large disasters, saw an underwriting loss of $411 million, stemming from a storm loss in Australia, of all places, as well as foreign currency transaction losses. Berkshire Hathaway said it faced increasing competition in the market for property and casualty coverage, no doubt about that. Investment income, which includes dividends, interest on investments made by the Berkshire Hathaway insurance operation, fell 11% from 2014 due to decline in dividend earnings from Berkshire's stock holding and interest on other investments. That is basically how all insurance companies make their money. The Burlington Northern Santa Fe fell 6% to 5.4 billion, partly because of freight volume fell as demand for moving energy production fell, and we'll get to that in just a second here. Pre-tax earnings rose 4% to 1.5 billion as the unit improved operation performances. Berkshire Hathaway has invested in better locomotives, and of course they've been updating their tracks. Long awaited situation here. The energy sector, at least transport of energy from the Balkans, we see excuse me, as more of a temporary but at the same time sustained operation, however at a lower level, and we'll get to that in a minute here. The Berkshire book value measurement of net worth rose at 2.4% to 149,735 per Class A share for the first 6 months of the year. Meanwhile, Berkshire's float, the money Buffett and his deputies get to invest in the company's insurance operations, rose to 81.1 billion in as of June 30th. The Berkshire net profit was 4.0 billion, or 2,442. That's on their Class A shares, compared with 6.4 billion, or 3,889 a share a year earlier. Berkshire said the third quarter results will include a non-cash pre-tax gain of 7 billion related to a merger of Kraft and Heinz. Berkshire owns just over a quarter of Kraft Heinz. So this is some of the machinations going at Berkshire Hathaway, and in addition, they are closing a deal on something called precision cast parts out in Portland, Oregon. Given a typical premium, the price tag for an industrial company, which has a market value of 26.7 million as of Friday, closed in excess of 30 billion. At that size, the deal would rank Berkshire Hathaway's largest ever represented, the latest mega merger in the robust year for deal making. No doubt there's been a lot of deal making. Deal will be announced next week. Now, the precision casting largest stockholder is one of the largest stockholders, 3% stake. As of March 30th, founded in 1949 in Portland, it makes fasteners and turbo blades for aircraft, including the Airbus and Boeing. It also markets equipment for power stations, the oil and gas industry. The company generates around half of its annual sales, 10 billion, from big aircraft and engines. And of course, that is moving up. Even the Iranians are online to buy some Boeing's products. The Berkshire deal, I'm reading here from the copy from the Wall Street Journal, consolidations in aerospace industry as aerospace makers boost output, after securing orders for 1,000 new jets, pushing suppliers such as Precision Cast to cut costs and invest in new equipment. That is always the key, new equipment to be agile, as it has grown rapidly through a series of acquisitions also. But the stock price has been weighed by a series of production problems, destocking by one of its largest customers, and exposure to the pipeline business. Now, pipeline business, again, all these things are tied together, and we try to do this. When you speak of the petroleum or crude oil business, it does get a bit crude, if you pardon the pun. It's always been a temporary situation, and of course, oil prices are down and have been down for some time. Over the last 5 years, the company's shares have underperformed the S&P 500 by 30 percentage points, and that's what Buffett specializes in, these underperforming operations. The company fell short of Wall Street's estimates for its fiscal quarter ending in June, as profits fell 17%. That's according to Mark Dogan. I suppose total analysts that demand for the company's products remain depressed in the oil and gas sector. They need to move out of this. A quarter of precision sales come from energy and power market. It has targeted oil gas sector. Now, this is one reason the economic relations with the Islamic Republic of Iran are very important, because they will need companies like this to redo their energy restructure. Sounds like this is a comment here. Sounds like a typical business that would fit well. We already said that. That's from Clip Galliant, an analyst at Nomura, I suppose. That follows this. The job is to help other business succeed, like the rail and energy companies. Well, rail is a valuable part, but a long-term strategy, of course, for rail is obviously the moving of other products than energy-related products. Britain's largest deal to date is it take over 77% of Burlington Northern Santa Fe rail there. That was $26 billion in 2010. It also teamed up with a Brazilian investment firm, 3G Capital Partners, on another deal, this purchase of ketchup maker Heinz. And well, we don't need to go into that there. And he's on the table, in the market. He's all around. And for 2 years, it's been building its position in precision cast parts. Now, this would be, I guess, what you say, a more old-line type industry that is steadily improving its bottom line. One of Berkshire Hathaway's recent deals in the industrial sector was the purchase of specialty chemical company, and I won't try to pronounce that name, for $9 billion. So it's moving around here with acquisitions of large companies such as ICAR and Marmon Group. So Berkshire Hathaway rolls on, and let me see if we can find anything here. CNBC headline 10%. They're basically the same percent the earnings in Q1 there, and this is a cast over, so we won't go to it. Let's go now to the commodities futures market and get this report. It should be up here. Weekly swaps report. Let's see here. What is it going to be? I'd have to go back. Energy market report. That should be released today. Press releases, no. Now let's see. How did they submit it here? Nonetheless, it should be come flying up here. Comments of trade now. Market swaps division recently. Energy. Oh, here. Well, we'll see if this is it. Okay, this is the Energy and Environmental Markets Advisory Committee's report as of July 29th. I'm not sure if this is it or not. This is the U.S. Future Trade Commission announced the Energy and Environmental. No, this is an advisory committee here. We don't want that. We'll have to return. Wait a minute here. Well, let's get over to the U.S. Energy Information Administration. We've used that. U.S. refineries are running at record high levels. And we have a little graphic there. Gross inputs to U.S. refineries exceed 17 million barrels per day in each of the past 4 years, a level not previously reached since the EIA began publishing weekly data in 1990. Lower crude oil prices and strong demand for petroleum products, primarily gasoline, both in the U.S. and global market, has led to favorable margins that encourage refineries to invest in higher refinery runs. Refinery margins are currently supported by high gasoline crack spreads that reached a peak of 66 cents. And I think we talked a little bit about this in some work we did on Boston Red on refining business in California, and then went to the 66 cents. Higher demand for gasoline is